South Africa's economy contracted 0.2% in the third quarter in quarter-on-quarter seasonally adjusted terms. That compares to revised growth of 0.5% in the second quarter. The sharpest falls in output came from agriculture, construction, manufacturing and mining. In unadjusted year-on-year terms, GDP contracted 0.7% in the third quarter. Analysts had expected better, with a 0.1% quarter-on-quarter decline and a 0.2% year-on-year fall. Private sector business activity flatlined in November. The S&P Global South Africa Purchasing Managers Index came in at 50 during the month. A reading below 50 reflects contraction, while anything above that shows growth, and a reading at 50 is considered neutral. But downside risks remain. S&P has highlighted the port crisis in Durban as a challenge, as tens of thousands of shipping containers are awaiting offloading, and this is causing significant delays, which could act as a drag on private sector growth in the coming months if there is no improvement. Transaction capital has swung into an annual loss. The SA taxi owner has reported a headline loss per share from continuing operations of 99 cents. That's from earnings of 224 cents previously. Commenting on the financials, the group says the results reflect what has undoubtedly been the most challenging and disappointing year in its history. The minibus taxi industry has suffered under current economic conditions, where taxi owners have had to face higher interest rates, elevated inflation and greater fuel price increases, while fares have largely remained the same. This has meant that taxi owners have struggled to repay vehicle finance loans, and this has weighed on Transaction Capital's operations, with its SA taxi unit reporting a 3.8 billion rand loss for the year. The change in the fortunes of this division has led Transaction Capital to restructure its operations. Part of this includes the possible unbundling of WeBuyCars and listing the unit separately on the JSE. Transaction Capital has stated that it has no intention of pursuing a rights offer to prop up its balance sheet, and instead dividends will be suspended until the group has been successfully restructured. Lesaka has announced some shifts in the top spots at the Financial Services and Technology Group. It says that Chris Mayer's tenure as CEO will come to an end in February. He will remain a director. The firm has not yet indicated who will take over from Mayer, but the group has announced that fintech entrepreneur Ali Mazandarani will lead Lesaka as its executive chairman from the 1st of February. And Kuben Pillay, who is currently the chairman, will become a lead independent director. On the international front, Taiwan's Foxconn, the world's largest contract electronics maker and a major Apple supplier, raised its outlook for the fourth quarter on strong year-end sales for the holiday peak season. Let's take a look at this package for more.
iPhone maker Foxconn is feeling bullish about holiday season sales. On Tuesday, the Taiwan-based giant lifted its outlook for the fourth quarter. That is traditionally its strongest season, with consumers snapping up smartphones and other gadgets over the festive period. Now Foxconn says the quarter has started better than expected and will beat earlier forecasts of significant growth. The firm doesn't put exact numbers on its predictions. Foxconn is the world's largest maker of electronics for other brands and is the top supplier of iPhones. It says revenue topped $20 billion in November, the second highest figure on record for the month. Consumer electronics, including smartphones, saw strong growth on the year, although that was coming off a low base, with key factories facing lockdowns this time 12 months ago. The company says components and car parts also enjoyed strong growth. Last month, it logged a surprise 11% jump in third quarter profit, but warned that revenue for the full year would be slightly down.
Over in Europe, we've seen a number of German companies ditch investment plans, and for a closer look at the reasoning behind this, it's over to our reporter Ndao Lengletshela.
That's right. Now, this is according to findings by Munich-based Economic Research Institute, IFO. Most companies responding to its business survey said they have to cut their investment plans until the end of 2024. And joining me as we unpack the research further is DW correspondent Chiponda Chimbelu in Berlin. Thanks for your time today. Now, Chiponda, what can you tell us about the current investment climate for German businesses?
Thanks for having me. Well, the IFO Institute said that the investment climate has deteriorated noticeably, and that is due to higher financing costs, weak demand, and uncertainty regarding economic policy. Now, most of the economic data that is coming out of Germany hasn't been helpful for investment sentiment here. The latest official figures show that exports fell unexpectedly in October, and that was mainly due to weak demand from the rest of the European Union. Germany's exports to other EU countries fell 2.7% in October. Now, such disappointing economic data is only worsened by the ongoing questions about the German government's budget. The Constitutional Court ruling last month left a 60 billion euro gap in the national budget. So that's something that's put on hold government plans to foster green innovation. And it's not just that. The funding for programs to help companies cope with high energy prices, those plans are also in doubt. That's why we're seeing German companies scale back their investment plans.
Now, how is the mood playing out in different sectors, Chiponda?
Well, if we start looking at different sectors, the mood is most pessimistic in retail, according to the IFO Institute. It said companies in manufacturing, on the other hand, are the most optimistic. The majority of the companies surveyed said that they intended to invest slightly more this year than the next in manufacturing. But even in that sector, there were some differences. Manufacturing companies that need significant amounts of energy want to invest less. So when we look at the overall news, we need to bear in mind that some are once again calling Germany the sick man of Europe. There are fears that Europe's largest economy is becoming a less attractive place to do business. In fact, 1 in 3 German companies are said to be planning a shift of production abroad, according to Germany's Federation of Industries in its supply chain pulse check report from this year. Now, it found that 59% of companies say that energy security and costs are a major reason for German firms to invest abroad.
And what can Germany do to remain competitive in this tough economic environment?
Well, without doubt, one of the answers from the German industry would be that it needs cheaper energy. That has been a major issue for Germany's manufacturing and chemical sectors since Russia invaded Ukraine in February last year. The economic fallout linked to the war in Ukraine has been bigger for Germany than its EU peers, and the country is yet to find an alternative to Russian gas that is just as cheap. The government has tried to intervene, of course, with energy price controls. The trouble now is that those funds are in doubt because of the Constitutional Court decision that said that the government couldn't reallocate funds meant to fight the COVID-19 pandemic. The biggest issues right now are, of course, the energy prices and the rows about what to do with a country's budget. The government will need to tackle those issues to bring more certainty back. And then it will also need to find a way of encouraging investment and innovation.
Thanks for your time and those insights. That was Chiponda Chimbelu from Deutsche Welle.